Hi, I Jatin Visaria welcome you on behalf of UTI Mutual Fund. One of the simple way to invest in equity as an asset class is through passively managed fund which replicates an equity index. And for this, index funds and exchange traded funds, that is ETFs, are simple, easy to understand and low cost options. So today we are going to talk about their similarities and how they are different from each other. To start with, both of them are open-ended mutual fund schemes and are regulated by Securities and Exchange Board of India, that is by SEBI. From fund management perspective, both are passively managed by replicating an equity index, that is, both invest into the shares forming part of an underlying index and that too broadly in same proportion. As these are passively managed, generally the total expense ratio of index fund and ETF is less as compared to actively managed funds. That is, generally these funds are less costly as compared to actively managed funds. From taxation point of view, if the underlying is an equity index, in that case both will attract equity mutual fund taxation. Now let us see how they are different. One of the major and important difference between the index fund and ETF is the way of investing into these funds. Index funds are bought and sold just like any other traditional equity mutual fund schemes. Whereas, as name suggests, ETFs are listed and traded on the secondary market of stock exchanges. Thus, they can be bought and sold just like any other listed and traded securities. Investment in an index fund is made at end of the day NAV, whereas as ETFs are tradable, they can be bought and sold near to their real-time indicative net asset value, which is commonly known as INAV. Index fund broadly captures the closing value of an index, whereas ETFs gives the opportunity to capture the intraday index movement. If you want to invest in index fund, you may approach asset management company, or alternatively, you may also approach intermediaries like independent financial advisors, registered investment advisors, mutual fund distributors, etc. On the other hand, if you want to buy or sell ETFs, you may approach stockbrokers and carry out the transaction through stockbroking platforms. Lastly, if you want to invest in ETFs, you must have Demat account. Whereas for investing into the index fund, there is no such limitation. To summarize, ETFs and index fund both are passively managed low-cost investment option, whereas from differentiating point of view, ETF provides the ability to capture intraday index movement, whereas index funds are always invested at end of the day NAV, that is, they broadly captures the closing value of an index. For more detail, you may visit utimf.com. You may also post your queries or questions in the comment or reply section below. Thank you for listening and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.